Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage. He was identifying winning stocks with massive uptrends, like Riot Blockchain before it shot up 10,000%, Digital Turbine before it shot up 789%, Overstock.com before it shot up 1,000%. This power gauge comes from the legendary Marc Chaikin. Right now, you can get a free in-depth look at how his power gauge system works. A way to type in any of the 4,000 different tickers and see exactly where a stock is most likely to go next in any type of market. Simply go to chaikintrial.com for your free look. Again, that's chaikintrial.com. Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's September 15th, 2022. Beautiful Thursday down here in South Florida. I got a great guest for you this week, Mr. Marc Chaikin, the guy I've been following for many, many years, now a colleague of mine. We're going to talk the markets. We're going to talk what potentially could be a great buying opportunity in the next month. And he names names, he names sectors, all that and more coming up right now on Making Money. Once again, welcome to Making Money. This is Matt McCall. It's the 15th September 2022. Got a big guest for you today. We got Marc Chaikin. Not only as a colleague, I consider him a friend as well. You know, Marc has been in the Wall Street world for over 40 years as a trader, a stockbroker, and analyst. He's head of the options department for a major brokerage firm back in the day. And then he founded Chaikin Analytics. And that was to deliver proven stock analytics to investors and traders. And he has what's called the Chaikin Power Gauge. It's a 20-factor alpha model that's been proven effective at identifying stocks' potentials in both bull and bear markets. It's developed a computerized stock selection model, both using fundamentals and technical indicators. You know, Marc and Chaikin Analytics, believe it or not, they rang the opening bell for the NASDAQ back in April 2018. What a feat. What a legend on Wall Street. Without further ado, folks, I'd like to welcome Marc Chaikin to the show for the first time. Obviously I just gave you an intro on Marc, but I will say this. He is one of the nicest people I've ever met. I followed him for many, many years before he came over and joined the Stansberry family. And I remember the first time I met him, he shook my hand, looked me in the eye, and actually spoke to me. A lot of people look at me and they look the other way, but one of the nicest people I've ever met, and pleasure for having him on the show. So thanks for being here, Marc.
Matt, it's great to be with you.
So, Marc, let's jump right into this. You know, the big thing right now is obviously inflation. You turn on CNBC or Bloomberg or whatever you're watching, it's going to be the headline almost every single day. You know, we have food prices going up, rents going up, home prices still near highs. What say you with inflation today, and where you think we're going to be going in 2 years?
Well, I always like to find an analog, meaning a period that's comparable to the one we're in. And a lot of people are focusing on 2008 or the bursting of the internet bubble because they have what's known as a recency bias, you know, and I go all the way back to 1973-4 when inflation was giving us the similar kind of headaches and headwinds that it is now. But I'm more dialed in on the Fed than I am on inflation, because you're going to see predictions all over the map in terms of commodity prices coming down, energy's down. So is it really a problem? I've always subscribed to the sort of Marty Zweig theory of the market, which is to watch the Fed and listen to the market. And if you take those two simple tasks, the Fed is telling you what they're going to do. There's no ambiguity. Powell keeps reinforcing it every week, starting with the Jackson Hole conference. The Fed is going to keep their foot on the brakes and do whatever it takes to break this inflation cycle. So I'm focused less on inflation and more on the Fed and the market's reaction to the Fed.
That's a great point. You know, I remember many, many years ago, 20 years ago, I remember somebody saying, you know, you don't fight the Fed. You can't fight them regardless of what the inflation number is. You brought up a good point here. We'll talk about the Fed more in a minute, but you brought up a good point about inflation. You know, a lot of people are saying, well, you know, gas prices have come down. You know, a lot of other prices, commodity prices have started to come down. Oil's come down. You look at the U.S. 3-year inflation expectations, they've come down from 4.2 just about 8 months ago down to 3.18. So you're starting to see the expectations come down. So with even though the Fed, as you mentioned, I agree with you. Powell's been very transparent that he's going to keep raising rates and take care of inflation. If we suddenly see inflation come down quickly, Kathy Woods from ARK Investment said this recently that she thinks it's going to drop dramatically next year. In that scenario, and if the Fed takes a foot off the raising gas pedal, do you think that sets up for a potential market rally if we do get inflation control at some point in the near future?
So, Matt, I've had a roadmap for 2022 and 2023 that's been based on the midterm election year cycle. So, going back all the way to 1904, in the previous 27 midterm election cycles, and obviously 2022 is the midterm elections, in 23 of the 27 cases, you've either been in a bear market or just come out of a bear market. So my scenario for 2022 has been a big, deep correction, typically September, October low, and then a rally of 30 to 50%. And I think it's playing out to script right now. The big question in my mind is, do we just have a retest of the 3,600 level on the S&P? Or do we go down to the targets from the big banks like Morgan Stanley and Goldman Sachs, which are in the 3,200 area, based on where they think S&P earnings are going to be? So what will trigger that? I don't know. It could be a big washout based on some problems that people are perceiving in Europe and the banking system because of the energy crunch over there. It could be because the Fed ultimately sees inflation coming down and does take their foot off the brakes. Something's going to trigger the ultimate bottom here in the market. And I just want to be there when that happens.
So that being said, it sounds as if you don't think the low that we had a few months ago is in as of yet. I mean, we hit like just close to that 3,600 in June, rallied back to 4,300 in August, now around a 4,000 level. So do you think that we will retest that again, or do you think that that was a bottom in June?
I think the bottom will be in October, and it's still up in the air whether it'll just be a retest. My sense is that whatever's going to trigger the next wave of selling is going to be big enough and something we may not be anticipating that we will break that 3,600 level.
Okay, so I don't like to hear that. But that being said, as a long-term investor, Mark, I will say if that does happen, I can imagine there's a lot of stocks on my watch list that will look pretty darn good at those levels for 5 to 10 years out. So I assume you're looking at it in a similar way that I am, that if it does bottom in that October timeframe, that you're going to be picking up some quality stock at that point.
My number one buy on weakness is Tesla. And I never thought I'd say that because, this is a stock that's been richly valued. Overvalued is a term I don't like to use because it's relative. Richly valued. I'd love to see Tesla test the 200 level. Remember, it split recently again. It traded down to 200 in June, rallied up to 260. And they made an announcement yesterday, which really excites me. And I've never viewed Tesla as an electronic car company. I viewed them as an energy storage company. And they just announced that they're going to build a lithium processing plant. Elon Musk, as controversial as he is always one step ahead of everybody. Whether he's building rocket ships that come back to a spot that's preordained, which I find to be unbelievable, or whether he's figured out how to build electronic cars and have his own supply chain. The guy's a genius. And if he follows his mission of becoming an energy storage solution, which I really think we need in America, I want to be in Tesla for the next 5 to 10 years. I just want to 5 to 10 years. I just want to buy it at the right price. And for me, that 200 level is very, very appealing.
You know what? I cannot agree more again with you. I wrote an article, it must be maybe 2 years ago now, on Tesla saying that I think it could be a $3 to $5 billion company by the end of the decade. At the time, it was maybe a $500 million. Now it's about 900 and some odd billion. And I agree with you. And my thesis, Mark, was exactly that. Not as a car company, even though it is a leading EV company in the world, it's about energy storage. And the future right now is all about energy storage. It's about battery power. And, it's tough to bet against a guy like Elon Musk, as crazy as he may be. I remember back in the day growing up outside Philly, we used to sneak off to a Philly park and bet on the ponies. And the old guys always told me, bet on the jockey, not the horse. And that's how I look at Elon Musk. I'm betting on the jockey, that I believe that he will come up with something in energy storage, and that company alone will be worth trillions of dollars just based on the energy storage aspect of this business, let alone what else he may come up with in the next 10 years. And I'll tell you, if Tesla comes out of 200, I may move my entire retirement account into Tesla at that point and put it in a coffee can for 10 years and walk away.
I'm not a big walk away kind of guy because I lived through 1973-4 where stocks got haircut by 90%. I mean, big household names like IBM, Eastman Kodak, and Xerox. But I agree with you. The potential here is enormous. And I'm going to pair it up, by the way, with a more conventional energy play because he is still, an answer to the green gas problem. EQT, speaking about Pennsylvania, is the largest natural gas producer in America. And they've just announced a big acquisition. They're in the Marcellus shale fields, and they've just announced a big acquisition yesterday or 2 days ago in West Virginia, extending their territory. If EQT was an independent country, they'd be the 12th largest natural gas producer in the world. And here they are in Pennsylvania, really good institutional support. Natural gas is, in my view, the solution, the medium-term solution, meaning 5 to 10 years in this country, as we build the infrastructure for electronic vehicles to move away from carbon. I think natural gas, which is our natural resource, just like the Saudis have crude oil, we've got natural gas. We've got to develop that. We've got to green light fracking. I think the next administration is going to come to their senses. They're starting to do that in Europe. The new Prime Minister of England is now said she's in favor of fracking. So I'm going to pair up my Tesla buy with a very high quality natural gas company, EQT. It's almost like a pairs trade, except I'm not short, I'm long two different stocks.
My research team and I have been talking about this a lot over the last year about, the transition to renewable energy, clean energy, net zero, whatever you want to call it. There's these high aspirations of governments and of companies, and it's going to take much longer than people believe. And I agree, in an interim, whether it be 5, 10, 15 years, we still need to rely on fossil fuels. And again, we are the Saudi Arabia of natural gas, as you just mentioned. Why not back that? And I think that's a great way to play that, because you're playing both sides of the angle. It's a very interesting pairs trade, because like you said, usually pairs trade, you go long something, short something else, but going long both. So of the sectors out there right now, would energy be one of your favorites, Mark?
It would, and perhaps I should tell your viewers that I've built a quant model 12 years ago based on 40 years of working with institutional investors of every style and time horizon. And we call it the power gauge rating. And it's 20-factor model. It's 85% fundamental and it's 15% technical. And the reason I'm bullish on Tesla, in addition to the long-term story, is our power gauge rating is bullish, as is our power gauge rating on EQT and a lot of the energy stocks. So yeah, we've actually navigated what I've been calling this rolling bear market since really February of 2021, when the tech stocks peaked, by focusing on the opportunities in energy. So natural gas comes to mind. Some of the drilling equipment companies like Helmerich and Payne are very interesting to me. There's a more leveraged play in natural gas, Southwest Energy, SWN, not SWX. And so energy to me is top of mind. And the European gas crisis is just one manifestation of that, the European energy crisis. But I do think that we're in a cycle where energy stocks are going to be up for 3 to 5 years.
Yeah, and a lot of them pulled back, Mark, too, as of late. So I think, if you're looking to get into it for 3 to 5 years, this pullback that we've seen in a lot of, EQT's held up very well, but a lot of the other energy stocks have pulled back from the highs as oil prices and gas prices have come down. So do you see this, and is the power gauge giving you any type of indicator that this is a nice time right now to start building positions?
I do. I think there's a tug of war going on Wall Street. Goldman Sachs is talking about $120, $130 a barrel oil by year end. Some other people feel that it's more likely to head closer to 60. So in the traditional energy play, I'm looking at Oxy. I want to sort of piggyback on Warren Buffett's ability to buy 51% of the company. It's had a really nice pullback from 77, which was the sort of spike top when the Buffett announcement came that he had gotten approval internally for 51% ownership. And I think if you can buy Oxy down here 15% off the high, that you really got a good long-term investment.
All right, so we know you like oil and gas, energy stocks. You mentioned tech a few minutes ago. What's your view on technology stocks right now? You know, you mentioned earlier, you know, they basically topped out February 2021, so they've been really in a rolling bear market, as you called it, for about 18 months now. Do you think the tech stocks are near bottom, or are you still avoiding them at this point?
Well, it depends what you mean by tech, because tech is now such a broad term. It encompasses everything from Apple and Microsoft, which I don't believe are cyclical stocks, to NVIDIA and AMD, which are cyclical stocks. So I would avoid the NVIDIAs and the AMDs of the world until we really have made that bear market bottom, because the cyclical decline could be 65% as it is now, and NVIDIA could be 85%. We don't know. Um, in other areas of tech, you're seeing some interesting earnings reports where some of the cloud stocks and the software as a service stocks have beaten estimates. DocuSign, example, just the other day, better than expected earnings. And you know, if you look at what we do in terms of closing contracts and buying houses, DocuSign is front and center. It's just with all these stocks, a question of when demand overtakes supply. So broadly speaking, I think tech has to be broken down into the various components. And but there is one area of technology that I know you're a big fan of, and I am as well, and that's medical technology, medical um, records technology, medical access technology. And there's a stock, unfortunately, that's bearish in our power gauge rating that you like and I like long term, and that's Doximity. I think Doximity is a heck of a company. They're the only company in medical technology that I know that's actually making money.
Mhm.
You know, comparing it to, say, a stock like Teladocs, which has never made money in 22 years. Doximity intrigued me when they went public a year ago. And here's a company that's making money. Every doctor I know is signed on to their system. They have 80% of the doctors in America. They're making healthcare more efficient. They're making doctors more efficient by enabling them to network. You really know the story there. And unfortunately, it's got a bearish power gauge rating, so I'm going to wait until it goes back into an uptrend, because technicals are part of our rating. But a company like Doximity, I consider tech, and that's a place I want to be over the next 5 to 10 years. I want to be in anything that sort of enhances healthcare in America and makes the whole healthcare experience better.
Yeah, you know, the healthcare industry, Mark, I'm glad you brought that up. It's such a large portion of our GDP here in the States, and really in a lot of countries around the world. But to me, healthcare is still so behind. And it's fascinating. When I was in Nicaragua a couple weeks ago, I was pretty sick and ended up in a hospital. But I went to a couple clinics first, and just showing that we're ahead of where Nicaragua is in the clinics. But you get to a beautiful hospital, Managua, and I got to tell you, I was in the hospital, and when I left, I told the doctor, I said, I'd love to send down an entourage of doctors or hospital administrators and watch how this was run. It was the best run hospital, the cleanest hospital. They got all the right tests. They got them back to me right away. It was absolutely amazing. And looking then, you know, at a country like that, like Nicaragua versus the US, and we're behind when it comes to a lot of that stuff. It's amazing. And being a multi-trillion dollar industry, just think about the upside for Doximity or some of these healthcare IT companies that literally are going to change the world in the next 10 plus years. I agree with you. I think there's a lot of great opportunities there, but I also agree, Mark, that you know something like Doximity, I think it's going to be much higher in 10 years from now. So I take a different approach than you. I'm willing to hold it and let it kind of go up and down. But yes, if we do that pullback in October, I agree, Mark. We're probably going to see a lot of these tech related healthcare stocks come even lower.
Yeah, Doximity seems to have found a really nice base in this 2832 area. So I'm not sure that there's economic rationale for it going that much lower, except, if we get an emotional selling wave in the broad market that carries down all of these stocks, in these baskets that the computers start pounding.
Yeah, that's the thing. Doximity may be a nice value here, nice long term, and it is building a base. It's holding the May lows, but if the market takes one more swoon down, most likely it sweeps up a lot of stocks, including Doximity, in that at the same point. So, do you think the rally? I think I know the answer already, but the rally that we've just seen from 3,600 to 4,000 ish or so, bear market rally right now that people maybe, if you're a short term investor, let's say, sell into this, wait for the pullback. If you're sitting on cash, should you sit in your hands and wait? At what point do you start kind of nibbling back into quality stocks?
Well, I want to nibble back in on a test of 3,600. If they go back above the 200-day average, which has been declining for quite a while now, on the S&P 500, that would be a wake-up call for me saying, okay, whatever's driving this rally is bigger than the Fed. But I will tell you this, that typically in bear markets, you don't bottom out until the first Fed rate cut. And most bear markets are triggered by Fed tightening, by draining liquidity from the banking system. And there are exceptions to that. 1987 being one of them, where you just got a waterfall decline. But typically you see the Fed take their foot off the brakes and lower interest rates before you see a bottom. So I'm going to call this a bear market rally. It was very narrow in terms of breadth. I'm sure you know this, but 5 stocks accounted for 40% of the gain in that rally from 3630 all the way up to 4300. So that's a sign that the broad market didn't really follow the generals or the tech leaders like Apple and Microsoft.
So when it comes to the power gauge, Mark, do you use that more for the market? How do people incorporate that into their investing style?
Interesting question, Matt. There's 2 ways to use the power gauge. One is for bottom-up stock picking. So that leads me to the EQTs of the world, to the Teslas of the world, and in this environment, the defensive stocks, the food stocks, the beverage stocks. But an even more powerful way to use it is top-down, which is how all the big institutional investors have some sort of top-down process, unless they're just pure gunslingers, finding great names. So for me, it starts not with the market, but it starts with sectors. So we have power gauge ratings for the 11 select spider sector ETFs in the S&P. And then I drill down into the sub sectors, which are industry groups. And that leads me to energy. It leads me to metals and mining. It leads me to the stocks where the money is flowing, basically, because there's always a technical component alongside the fundamentals. So right now, the power gauge is telling me that energy is still front and center. Tech is to be avoided. There's biotech, and some of the healthcare stocks are very attractive at the industry group level. And actually, we're building a solid base because recently you had 6 of the 11 sectors with bullish power gauge ratings, which is unusual in a bear market. So I use the power gauge in that sense, but we do have something new coming up where we're using the power gauge more from a bottom-up point of view, and I'm very excited about that.
I'm more of a top-down guy. I like to take the sectors from there, and if the sector's strong, I feel like I have a better probability of picking a stock in a sector that's going up versus the bottom-up approach, like you call them gunslingers, trying to pick that one stock in a really bad sector that's struggling. So would you, the bottom-up that you're working on, if it flashes an amazing buy for a stock, let's say, but you look at the sector and you don't like the sector is not good as far as the power gauge is concerned, would you still go for a stock like that, or do you like to see them all kind of line up?
In a bull market, I would definitely go for it. In a bear
Okay.
market, when you've got headwinds overall in the market, I think you're playing a loser's game doing that. But you can differentiate within a sector. So we mentioned semiconductors. NVIDIA right now is a bearish rating in our model. Over the years, it's tended to be very bullish all the way back to 2013. AMD has much stronger fundamentals in our model. it's in a downtrend, as almost everything is right now. But uh, I can differentiate between an AMD and an NVIDIA and tell you that if I'm going to buy a semiconductor stock right now on weakness, it's going to be AMD, not NVIDIA.
That's interesting. I like both those stocks long term. Here, I wouldn't buy them. I mean, Nvidia actually just last week broke through the earlier 2022 low, which most stocks have been holding up, and it actually broke through. So that's obviously from a technical perspective pretty darn negative. You mentioned there's 6 of 11 are actually bullish now, which that kind of caught me off guard. That surprised me, as you mentioned, in a kind of a bear market rally here. I saw a stat recently, Mark, and I can't remember exactly where it came from. All the charts we all look at every week, but it was talking about the healthcare sector and how cheap it basically is right now relative to its level over the last 20 years or so. Is that a sector that you'd start looking at some point in healthcare, whether it be in biotechs? We already talked about the technology side of it, but maybe some more traditional healthcare stocks, just with where the world's going and the breakthroughs we could see in healthcare in the next 10 years?
Absolutely. I was with an old friend of mine who is a very savvy investor and invests typically with the hedge funds. But he said, Mark, I made my first stock purchase in about 3 months. I bought a big position in Pfizer.
Hmm.
And I think if you're looking long term, there's real value in some of these big pharmaceutical companies. Bristol Myers would be another stock I'd look at because they bought Celgene a couple of years ago, and stem cell research to me is the future of of curative drugs. But I would look at these stocks as attractive. And what intrigues me about healthcare is it's always been considered a defensive sector, along with utilities and consumer staples, food, beverage stocks. But healthcare is really a growth industry, as we talked about earlier. And so I like the fact that healthcare incorporates both defensive characteristics and growth characteristics. It's just a question of finding the right names. And so there are three industry groups within healthcare that have bullish ratings in our model: pharmaceuticals, healthcare providers, the big guys like Centene and United Health, and then biotech. So I think there's plenty to look at. Medical instruments, not really bullish right now, but there's so much to love in terms of a pretty decent dividend stream on some of these for dividend-oriented investors. But I would definitely be looking for long-term value in healthcare.
Yeah, I couldn't agree more with that. One sector I wrote about earlier this week or last week, I can't remember, it all kind of meld together, was aerospace and defense, because one of the EU heads of some organization came out and was talking about the stockpile of weapons has really gotten low for the European Union, as they've been, obviously giving a lot to Ukraine and haven't really spent a lot of money kind of rebuilding the stockpile up. You have Japan, who's now basically changing their law that's been around since World War II, where they can start really kind of ramping up their military again and buying a lot of obviously weapons and stuff from aerospace defense companies. The U.S. continues to spend a ton of money on it as well. Is that an area that off the top of your head, is that a bullish area right now in a power gauge? And how do you kind of view that sector going forward?
Long term, I think aerospace and defense is really critical. I don't see the immediate opportunities there. I mean, I'm always intrigued with Raytheon. That's a missile provider. I think the merger that they just entered into is good long term for them because it diversifies the risk. But I don't see specific opportunities right now in aerospace defense.
Okay. So I need to ask you about one sector that I've been bearish on for a long time, and I get grief everywhere I go about it. That's precious metals, gold in particular. I'm not a fan of gold. I just think it's an investment that has worked at some point in time, but has not worked recently. I mean, we've had inflation through the roof, the highest since the 70s. Gold should be going through the roof, according to the gold bugs, and it's doing the exact opposite and trading near a multi-year low here. What's your view, either your view or Power Gage's view, on precious metals and gold at this point?
Bearish right now, very similar view to yours. I've just never had a handle on gold. You had the commodities guy on, Jim Rogers, a few weeks ago, and Jim really has a good handle on commodities. If gold's not going up with inflation at 40-year highs. When is it going to go up?
Exactly.
And the power gauge reflects that. This should be gold's moment,
Yeah.
and it's not happening. So I think the whole concept of gold as a store of value is being replaced, certainly at the generational level, your generation versus mine, by Bitcoin and cryptocurrencies as an alternative store of value. I don't get the whole gold story, and the gold bugs are dying off. All the gold bugs. I think was it Harry Dent and a couple. The guys that have been flogging this horse for 40 years are getting old in the tooth, and I don't know anybody who's going to be promoting gold 20 years from now. It's going to be something in crypto or blockchain that's going to replace gold in everybody's mind as a store of value.
So you obviously you know a lot of really big money people in this industry. You've been doing this for a long time, and people have been relying on you for decades for your information, Mark. Me being one of them. Um, are you hearing anything from some of the hedge funds and the big guys out there? Are they interested in cryptocurrencies? Are they interested in Bitcoin? Or are they kind of waiting for more regulation, waiting for it to kind of mature a bit before they even consider it?
I'd say they're waiting for it to mature. Some of them were early adopters, but in general, I think they're looking more for the story stocks and less for alternative assets. I think people who want alternative assets are going not to the hedge funds, but they're going to specialized pools of capital that are dedicated to that. So, I mean, the traditional hedge fund is maybe they have their toe in the water, but and as the big banks like Goldman and J.P. Morgan get in line and support more liquid trading in crypto, maybe, but I'm not seeing anything that I'd call a groundswell there.
I was saying I had Kevin O'Leary on last week, and we were talking about cryptos, and he said the same thing. A lot of the big firms need to have more regulation before they jump in, unless you, like you said, unless you were an early adopter years ago, you're already in. Um, but I think it will be adopted at some point. I think at some point it will take over some of that allure that gold has as a store of value, but still extremely volatile right now, and it's tough to just hold on and watch the daily swings in it. But something that I know it's coming up here in a couple of weeks, Mark, is you're partnering up with Joel Littman from Altimetry, another one of our colleagues. Very smart guy, especially when it comes to accounting and kind of diving into companies much more than I could ever imagine. And you guys are partnering up, looking for basically the perfect stock is what we're calling it. Do you want to tell me a little bit more about what you guys are working on and what you're going to be releasing in about a week or so?
Well, Joel is an absolute genius when it comes to forensic accounting. And the power gauge rating is 85% fundamental. And we look at earnings, we look at um, analyst estimate revisions, we look at whether companies beat or miss versus Wall Street expectations. But our database, which is the best database in the world, it's the Standard and Poor's fundamental database, uses GAAP accounting. And GAAP accounting forces companies to do things that they don't always want to do. And what Joel Littman has done is put a team of forensic accountant data scientists looking at 32,000 companies worldwide to see where there's an edge. And, we all want an edge. And Wall Street is sort of the big bogeyman in everybody's view. I mean, everybody thinks Wall Street has the edge, but models like the power gauge rating, like Joel's altimeter, can give the individual investor an edge. And so what Joel's been successfully doing is finding companies where the GAAP accounting and the real world earnings potential are diverging. And he's had a great track record. And you asked me earlier how you use the power gauge, and I said top down or bottom up. And you and I both favor that top down process. But it's also a great filter, a sort of prism, a lens to look at other people's research, whether it's Matt McCall's, whether it's Joel Littman's, the altimeter. And that's what we're doing. We're basically creating a portfolio, and we're going to give a free recommendation of stocks that are sort of supercharged because they pass through Joel's very rigid criteria of looking for disparities, both positive and negative, and the power gauge. And so that synergy between the power gauge rating and the altimeter is just unbelievable. It's basically doubling the longer term performance of Joel's portfolio, and it strips away a lot of the losers. And that, as you know, in our game of picking stocks and building long term portfolios, there are always losers. You're going to make your money on the 2 or 3 big winners in a 10 stock portfolio. If you can just eliminate 1 or 2 losers every year that cause you pain and sleepless nights, that's a win. It's a win
Mhm.
at the bottom line. It's also a win psychologically. So what Joel and I found when we merged these two systems together to create the concept of the perfect stock and the perfect stock portfolio is not only do you supercharge the winners, but you eliminate some of the losers by overlaying the power gauge on top of Joel's research. And that's what we're very excited about. Uh, we'll be launching on the 22nd of September. And I think it's unique, and it's also very timely for this bottom in the market, in the bear market that I see coming in late October.
Yeah, I love how you're marrying together two strategies as well. It's like anything in life. If I could sit down and have more tools in my toolbox, I'm going to be better at whatever I'm doing. Whether I'm sitting down at a blackjack table or I'm building a house, the more that I have, the more tools that I could use, the higher the odds that I'm going to be successful at whatever I'm trying to achieve. So taking, obviously your power gauge and then taking Joel's gauge as well and adding those together, and you're just eliminating, like you said, more potential losers. So I'm super excited, and we're going to put a link up down here right now for those of you that want to sign up. It's going to be on the 22nd of September. So sign up now, get on the list. We'll let you know when it's going to happen. And as Mark just said, they're going to actually have 2 free stock recommendations and 2 free warnings coming from both Mark and Joel on the 22nd of September. So I'm excited for it. I know I can't know the names ahead of time, but I want to know what the heck they are too. So I'll be watching, Mark, both you and Joel, to find out what it is, and I can't wait to see over the years what you guys come up with. And again, you mentioned there the timing. Timing is very important in a market. Especially for those of us that don't invest for 10 or 20 years like me. And the timing now coming out, near that bottom potentially in October. Boy, what a great time to have a new service coming out where we can get new stocks to put to our watch list, potentially buy in the next month or two. So I applaud you for doing the timing, both you and Joel, on coming out with this. And I couldn't be more excited, to be honest with you, to see where this goes and what kind of stocks you come up with. And of course, I like putting my stocks in the power gauge to see where they are. A lot of them, because I'm tech oriented, Mark, don't come up too well right now. I will say that, but we're hoping that changes here in the next couple of months.
It definitely will. I mean, there are stocks that you've recommended that I absolutely love from a fundamental point of view, MP being one of them. And it's just a question of this bear market being over and people's sort of speculative juices coming back into play. But I think there's going to be a rally that's going to shock people coming up because it's following past history very, very closely, and that coming out of the midterms is typically very bullish for the market.
Yeah, and I'm ready for the midterms to be over because I can start seeing these ads already on TV, and it just drives me bananas. So I'm ready for them to be over as well.
Yeah,
So
especially down in
before
Florida.
Oh, down here it's crazy. I didn't have a TV for the last 2 months. I'm renting a townhome, and they brought a new one in yesterday and turned it on. The first thing I'm seeing is the news, and I turned it off right away. I don't need to have this TV on right now. I have to read the news every day as you do for the market, but boy, I don't need to see that political stuff. So
Well,
I
that's
asked
also
Mark.
my advice. I'm sorry,
So
that's my advice for investors. If you're watching CNBC, turn off the sound.
yeah,
You know, if you want to see what stock prices are doing, fine, but you just don't want to hear all that chatter. It's so distracting. And that's been my mantra for the 12 years that we've been marketing the power gauge to individual retail investors. Ignore the headlines. It's just noise. It'll throw you off. It'll throw you off your long-term strategy. Even if you're a trader, it's more likely to cause you to make an emotional decision, and typically that's in the wrong direction. So couldn't agree more. Turn off the sound.
Yeah, I was obviously worked for Fox News for about a decade, so I was one of those talking heads at one point. And looking back on it, I can't believe some of the stuff I said. I never lied or anything, but you get it's entertainment. And I'm not going to name the guy's name, but the guy is on CBC who's loud and obnoxious. Sometimes watching, it's like one day bullish, next day bearish, one day bullish, next day bearish, and for the average investor at home, they shouldn't be switching around their 401k or IRA
No,
based on every 2 days of what talking heads say. It really does an injustice to what they're trying to achieve. But it's entertainment, so I understand where they're coming from. Before I let you go, Mark, I always ask my guests, and I probably know your answer already, but it's the island question. I said, if you have 10 years, I put you and your family and whoever you want to take with you on the nicest island for 10 years. You can't look at the internet and market, nothing, but you can buy one investment for the next 10 years. It could be an asset class, it could be a farm, whatever you want. It could be a stock. What's that one thing you want to invest in for the next 10 years?
that would be Tesla.
Yep. I kind of guessed that, and that's based on, as you mentioned, the energy storage, right, and what the potential of Elon Musk, I assume, in the next 10 years.
Exactly, and also the lead he has in EVs. I mean, GM just announced an electronic vehicle. What do you think the price tag was this morning?
Probably a high.
80 grand.
Wow.
I'd rather buy a Tesla than an $80,000 General Motors bolt-on.
Yeah.
So, but it is really energy storage, and it could be hydrogen. Who knows where he's going to go with it? Right now, he's talking lithium batteries. I'm gonna bet on Elon at these prices.
I love it. I love it. I mean, I always like when they guess. I agree with the 10-year thing. I don't always. I think Jim Rogers said silver, and I didn't quite agree with that. Somebody said gold once, and I cringed. But I'm excited to watch the unveiling with you and Joel of the new combination of what he brings from altimetry and your power gauge. So I can't wait to see what you guys roll out on the 22nd of September. Again, there's a link right there. Sign up for it. We'll give you updates when it's time to go live. But Mark, thank you so much for coming on for the first time, and I hopefully will have you on again soon. I'll see you in a few weeks at the Stansberry conference, I'm sure. But until then, be safe, be well, and we'll talk real soon.
Matt, it's been a pleasure. Thank you. Yep, look forward to catching up in Boston.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.